Joining us right now, former Fannie Mae executive Tim Rood and real estate home builder Jason Meister in studio. Gentlemen, good to see you. Thanks so much for joining us.
Thanks for having me.
Tim, let me kick this off with you. How do you characterize things right now?
Well, we're optimistic. I mean, you got to believe in something, Maria. I mean, the stock market's let you down, commodities, bonds. I mean, there's a lot of good reasons that people are focusing on housing as one of the last legitimate opportunities to create wealth. You know, we're seeing a couple of things. Inventory continues to go down, yet the sales continue to go up. And that reflects too expensive rental markets, an improving jobs market, and generally cautious, optimistic outlooks for any other asset class. All
right, but inventory is not going down everywhere. Jason, let's talk about the inventory and where you see perhaps areas of bubble or perhaps close to peaking?
Sure. Maria, I can't believe we're still talking about a housing recovery. It's been over 7 years.
Yeah.
I mean, interest rates have been at near zero, and we're still talking about a housing recovery. It's pretty staggering. We've had a lot of overseas buyers that have been propping up markets like New York City, Miami, San Francisco. Obviously, that's not across the country, but I'm nervous because I'm starting to see that overseas buyers starting to pull back. And we've also had overdevelopment. The uber luxury market of New York City has been overdeveloped. We have a glut of inventory coming online, a shadow inventory. So there's a lot of reasons to be concerned. And what I look at is I look at the job numbers. People pay for homes with their jobs.
Right, sure.
And we have a real unemployment rate in this country that's north of 10%. Forget the 5% we continue to hear about. We all talk about the labor participation rate.
Yeah.
The economy's not doing as well as people talk about.
But isn't that the upside to the real estate, the residential real estate market outside of where you have the foreign investors? The demographics of the millennials that are going to, over the next 5 years, number of people turning 30, is going to match almost the peak of when that happened with the baby boom generation. So from 85 to 00, you had this huge demographic shift that you're embarking on with the millennials. How do you offset that with some of your investment fears from overseas investors?
Sure, but what my concern is the jobs. Where are these millennials going to get these jobs that are going to then be able to actually buy homes with those jobs?
Well, the one thing that people don't realize is that incomes are underestimated by over 8% a year since 1965, according to the government. So we know that the incomes are underestimated, and the millennials are working in a different way, Jason. They're working as single-person companies instead of W-2 employees, which isn't captured in the data. So there is an opportunity for incomes to be growing more than you actually think they might.
I've got a question, because let's look at this from the bank side. You've got to go get a mortgage to get your home.
Well, standards are much higher today.
Right. The standard, the point I'm going, the standards are higher. How are these millennials going to actually meet the standard? And then add to that, what if the Fed finally comes out and goes up 50 basis points and it becomes more expensive to borrow? How are they going to buy the house? And I can't be optimistic.
When I was 25, I wasn't thinking about creating a household, and I certainly didn't have money to do it.
What about that, Tim Rood? Tim, jump in here. I mean, in terms of, it's very difficult to even get a mortgage today.
Yeah, I mean, it's loosening, but the problem is every time interest rates go down, it actually credit tightens because it's indicative of a weakening market. But I mean, the best proxy for the millennials, we keep thinking about household creations, we think about the job market, we see these top line numbers, I'll give you the best bottom line number is that the share of millennials 25 to 34 years old living with their parents is up in 2015 than it was in 2014. So something is broken, the labor market or otherwise. But the good news is you see the housing market recovering despite that. So that's pent-up demand for the next 5 to 10 years.
Maybe they're just spoiled.
Well, they have the investors coming from overseas, as Jason points out. You have Chinese and emerging market currencies that are getting smoked. Those people want to move their money to somewhere that's stable.
Money's coming here from China, right?
But there's a lot of Chinese money, there's a lot of Russian money, there's a lot of Middle Eastern money. But again, it's starting to pull back. What I'm really concerned about is where we're headed, what trajectory are we headed, and I watch those job numbers when we talk about housing.
How significant a decline would you expect in real estate prices in the coming year? Because I know that you're looking at a lot, you say inventory's up.
Yeah, real estate is local, so I would take it market by market.
Go to New York. Tell us New York. We care about that on Saturday.
Yeah, in New York City, above, and I know this is a crazy big number, but above $4 million, that's almost frozen market right now. But between 3 and 4 is very tough. Below $3 million, things are going off the shelves. I think those prices have to come down quite a bit. We're starting to see UCC foreclosures again. We're in that cycle of the market where you're going to start to see prices come down.
$3 million gets you a 700-square-foot, one-bedroom apartment in New York City right now. And I'm not joking.
Really?
Buy across the river.
Tim Rood, Jason Meister, good to see you, gentlemen. Thank you. We'll be right back.